Good afternoon, everybody, and welcome to today's Professional Advisor Working Lunch, brought to you with our partner, Baillie Gifford. I'm Katrina Lloyd, Editor-in-Chief of Professional Advisor, and I'm going to be your host for the next hour. Before we get started with today's session, let me quickly run through the usual housekeeping. I should inform you this session is being recorded, and we'll send you a link of the recording by tomorrow. Do feel free to share this with your colleagues. And as usual, today's Working Lunch will qualify for 1 hour of CPD, and we'll be sending your proof of attendance along with the link to the recording of the session, which will arrive in your inboxes tomorrow. So I'm just going to move along my slide there. I'm just going to move along so I can see move on to our CPD slide. There we go. So let's get on with the session. As the AI revolution reshapes industries, global tensions intensify and tariff uncertainty drives inflation, investors are seeking stability amid change. Durable compounders, companies capable of sustained growth through varied market conditions, offer a compelling solution. I'm delighted to be joined today by Baillie Gifford Investment Specialist Alasdair McHugh for an insightful session as we explore their approach to identifying the world's most resilient compounders within their responsible global equity income strategy. Do feel free to put your questions to Alasdair using the chat function, which you'll find at the bottom of the screen. And if you wish to remain anonymous, then simply select my name from the drop-down list in the chat box before you type your message, so only I can see it. So just before I hand over to Alasdair, let me quickly run you through our learning objectives for today. So by the end of this presentation, delegates will develop an appreciation of the merits of quality growth investing, understand how consistent dividend growth can signal compounder potential, and learn how durability may become a prized trait in future market environments. So now let's hear from Baillie Gifford's Alasdair McHugh. Afternoon, Alasdair.
Hi, Kat. Thanks for having me. So if I can start, hopefully you can all see the cover slide of the presentation. First of all, thanks for giving up your lunch hour to join the webinar today. I know it's a precious hour for many people, especially in busy working lives. I'm going to talk about something which I hope is quite interesting to a lot of our audience. I'm going to talk about why it's great to be middle-aged. You see, I recently turned 40 years old, and that earned me an invite to my first ever company medical. I'm sure many of you have endured that slightly traumatic event, but as an Irishman who really loves his food, there was one part of it that really distressed me. So Baillie Gifford has Dr. Dave, a man who I think holds many secrets. And he met me and described how I might fight off the dreaded middle-age spread, as he put it. He looked at my address. He noticed that I live very close to one of Scotland's best fish and chip shops. That's Allanda's in Longniddry here in East Lothian, if anyone's out this way. And Dr. Dave basically described his strategy whenever he visits Allanda's. He orders a large fish supper, as I do as well. But before he starts to eat, he walks over to the bin and he tips half of his chips into the bin. Now, apparently that's because starchy carbs are the enemy of middle-aged men. That's something I'm beginning to understand. But growing up in Northern Ireland, growing up on a largely potato-based diet, I can tell you that goes against every fiber of my being. And I'm absolutely not going to be following that procedure anytime soon, even if it does mean that the belly does grow a little bit. But it did get me thinking that there must be some sort of upside to getting older. And a couple of days after that medical, I came across a blog post from this man. So this is Aswath Damodaran. And the blog post started to make me feel a little bit more optimistic about going into my 40s. So Damodaran is a professor of corporate finance at the NYU Stern Business School. Many of you might have come across him. He's well known as the Dean of Equity Valuation. And some of his recent work focuses on company life cycles, comparing those to the life cycles of humans. So you can see why this might be relevant for my recent predicament. What he says is that just like people, companies are born, they adapt quickly to their environment in their early years, they experience teenage growth spurts, they settle into maturity where growth moderates, and eventually they decline and they're replaced by younger successors. And he gives this recommendation that companies need to act their age. So he basically observes certain characteristics exhibited by companies at each stage of that company life cycle. And those emulate human traits as well. So younger companies are often unprofitable. They're often cash flow negative. They're investing heavily in improving their concept, carving out a competitive advantage. They're very hard to value because nothing's predictable. And often that valuation is done on little more than the vision of the founder, a plausible story about that company's route to market. As they progress through the life cycle, they hit their stride in the teenage years, that growth spurt ensues, cash flows in. And while the firm might remain unprofitable, you can start to see with a bit more clarity how the story might play out. And that makes valuation somewhat easier because you might have positive cash flows at this stage. Then you go through to maturity, and there's a lot more certainty. So firms they're predictably profitable, they're generating cash reliably, they're often returning that to shareholders in the form of dividends. And as Damodaran puts it in his book that's just come out, companies like Coca-Cola, which we own in our funds, they're in chapter 30 of a 60-chapter book. We know where they've been, we know where they're going with some degree of certainty, and that makes valuation much easier. It means that the path of returns for shareholders is also a lot smoother. Now, his recommendation or his belief is that companies that don't follow this pattern are doomed to fail. So, for example, young firms that are returning cash to shareholders instead of investing at the higher rates of return in the projects that are available to them, or the other way around, mature firms that are sort of trying to buy longevity through desperate acquisitions. Those sorts of actions, not acting your age, are recipes for disaster, according to Damodaran. And that's something we have a lot of sympathy with. And by the way, there's also massive ecosystems of consultants and investment bankers out there really trying to tempt companies into these fatal errors. So there are a lot of forces encouraging companies not to act their age. And that's a warning that I'm trying to heed as well, trying to adjust that calorie intake, trying to think about the slightly slower metabolism that I'm now faced with. So the reason I bring this up is I think at Baillie Gifford, we're pretty well known for investing sort of either side of that teenage test that was on my previous slide. The toddlers and the teenagers of the corporate world via our growth strategies, our high growth strategies like long-term global growth, like US growth, like Scottish mortgage. And in those strategies, we were very early investors in companies like TSMC, Amazon, long before they asserted their dominance. We found NVIDIA and saw the promise of that in its parallel processing power of graphics processing units. I think that was nearly a decade before generative AI went mainstream. So, clients will definitely know us for that high growth approach. I think some clients will also know us for our skill in sort of blending the different flavors of growth. So from rapid growth names such as those I've mentioned through to some of the steady compounders I'll talk about today, as well as some of the more cyclical names in some portfolios. So the likes of Monks in the investment trust world, Global Alpha, some of you may know, these are leaders in blending the different flavors of growth. But I think only our very longest standing clients will remember that actually Baillie Gifford's heritage lies not in finding fast growing tech firms, but actually in uncovering what we call in our team the uncommon compounders that can really underpin a portfolio and generate steady returns for a decade or more. And that's companies like Atlas Copco. It's a diversified Swedish industrial firm. It was first bought for clients of Baillie Gifford over 40 years ago. And it's managed to churn out a steady 10% per annum return since 1984. Now, I think it's quite understandable that we're not known for this style of investing. Our investments in the new technologies tend to attract the most of the media and the client attention, given that they often sit at the top of the performance lists, or indeed in volatile times at the bottom of those performance lists. But I think it's entirely possible that over the next few years, as geopolitical relations become more fractious and economies are buffeted by protectionist measures, I think being a bit dull in your growth approach could actually turn out to be really quite interesting. And that's something I want to talk about today, because this is where our global income growth strategies come in. Now, these are portfolios that do have a laser focus on those uncommon compounders, finding those companies that can grow at that steady double-digit rate and holding them in diversified, risk-aware portfolios for decades. Now, as with our high growth strategies, our edge here lies in time horizon, but it's really in leveraging that edge in a slightly different way. It's not about imagining that future 20 years from now and investing in the companies that we think will dominate in that future, the flying taxis or whatever it might be that we're known for investing elsewhere. Here, it's about investing in companies that probably exist today, but we think will continue to exist in 20 years. So for us, time horizon's the edge, but it's about the duration rather than the rate of growth, about companies that are able to persist for very long periods indeed. And that time horizon advantage is really important here because these are well-known companies. So everyone has a view on a Coca-Cola or a L'Oreal. But to uncover an uncommon understanding of these companies and investment insights, you really must have the time and the resources to go deeper than others in your analysis. One example of that in our team is that we have an investigative researcher on the payroll. So this is a really vital member of our team that has a background in investigative journalism. And she is really adept at consulting multiple on-the-ground sources to form a view on companies around some of the softer factors that typically influence a company's ability to compete. So recent examples would be speaking to radiologists about the devices they see the best results from, or going to Central Park and talking to dog walkers about their thoughts on pet insurance. These are all sort of deeper dives that we can deploy our investigative researcher on as and when we need them. And I think when you're considering some of the largest, most complex businesses listed in stock markets, that ability to go deeper, to spend more time than the competition is a really crucial source of edge for us. And over the 15 years that we've been running global income growth portfolios, we've observed that there's one trait that's very closely related to that ability to endure. And that is the persistence of a dividend, and indeed a growing dividend over time. Now, our clients own this strategy either for that income element that we'll talk a bit about today, but also we find a lot of clients owning this strategy because of its resilience, because of its durability. And that's where I want to spend most of the time in this session. Just flicking over to the next slide. This is what I'm talking about when I talk about durability and resilience. So these portfolios exhibit a trait that I think could be very attractive in unpredictable times, and that's downside protection. So what we're showing on this page here is that in the past decade, there have been 12 market falls of more than 5% in US dollar terms. 12 market falls of more than 5%. Our longest standing global fund has outperformed in 10 of those down markets. And it's done that because of this focus on mature, middle-aged businesses. Now, these are the companies that they have been stress tested extensively. They fought for their position in their respective industries. They've been battle hardened in the process. And I think, like those of us that are entering middle age as humans, they're formidable competitors because they're aware of where their strengths are, but also where their weaknesses are. And I think in a tougher environment, these are really desirable traits. And a portfolio of these sorts of companies can really participate when markets rise and protect whenever they fall. Now, I would say that relentless compounders like this are not easy to find. Only about a fifth of firms have been able to grow their earnings in excess of a 10% per annum rate over the last decade. And frankly, some of those are growing too fast to be suitable for a portfolio like ours, focused on the steady compounders. And a quote from the Damodaran work that I've read is that, some companies risk aging in dog years. Not all companies will proceed through that life cycle at the same rate. And that's something I'll come back to later. But that means that the compounders that we're looking for our portfolios are really uncommon. That's why I keep using this phrase. And this simple chart shows the distribution of growth rates from a very large sample of global companies over the 15-year period that we've been running this fund. So it's 5,000 companies, and it's taking rolling 10-year periods for each. And what you can see here is that about 2/3 of companies do not achieve that double-digit rate that we're looking for. That leaves about 1/3 that do. But because we're specifically interested in those that sit around the 10% growth rate, there's quite a lot of those that sit north of 15% or so that aren't suitable for our portfolio. So what we do is, we try to find these companies with an investment process that we fine-tuned over the last decade, our 9-question research framework. And our mindset is very much the strapline at the bottom of this slide. It's how can a company grow for 10% for a decade and then do it again for another decade? That's something that is a really rare accomplishment, and that's exactly what we're looking for in any of the stocks we own. So we're interested in the green zone on this page. And I mentioned very briefly one of the things that we can look for to try and uncover these uncommon compounders, and I'll just touch on that on the next page. We've experienced this over the past decade and more. What we find is that dividend growth is in fact a very strong signal of compounder potential that we can look for when we're trying to seek out these firms. Now, I want to be really clear here. Dividends alone are not a strong signal. Nearly every company offers some level of regular payout. What's important is a record of consistent dividend growth. So emphasis on the consistent and on the growth. Why is that? Well, it's because for a company to grow its dividend consistently over time, it really has to show great discipline in its capital allocation. It has to choose projects discerningly, and it has to work in the knowledge that some of its future cash flow is already accounted for. And that means it has to operate a business model that's profitable in even the toughest times. And also, it has to face into a very large addressable market. So what we tried to show here are the characteristics that these companies require at different points in time. So for a company to pay a dividend today, it needs to earn returns in excess of its cost of capital. It needs to be cash generative. It needs to show that capital allocation discipline that I've talked about. For it to keep doing that into the future, keep paying that growing dividends, even in a downturn, it has to have a really robust and conservatively managed balance sheet. It has to have a prudent payout ratio. And crucially, it needs to maintain profitability even at the trough, even in recessionary times. And then, over the long term, 10 years plus, for it to grow that dividend, it's harder still. It needs to have a really long runway for growth. It needs to have that durable competitive edge, and it needs to be a high quality, prudent management team. These are all things that we've observed over the decades that these companies that do endure exhibit, and it's things that we look for routinely through that 9-question research framework. Now, to be clear, there are certain business models that are definitely not compatible with this, particularly those in sectors that earn really poor returns on capital or that are highly cyclical. These are the kind of things you're not going to find in our portfolio. And I think the safest examples of those would be things like airlines, which are highly capital intensive, or automotive manufacturers, which, as we know, are from current time are pretty cyclical in the way they operate. The interesting thing is that there's lots of evidence that this signal of dividend growth actually works beyond our own performance record. So there was a seminal study back in the 50s by a chap called John Lintner, who looked at nearly 200 dividend decisions by American companies. And I think the results of that are still really relevant today. So what he found was that companies were extremely careful to increase their dividends only if they believed that earnings had permanently increased. And what he did was he interviewed pretty comprehensively management boards. He observed that those companies, they really did focus on that sustainability of earnings over the long term. And I think that sort of supports the argument that dividends contain some pretty crucial information about a firm's prospects, signaling really strongly that earnings can be expected to grow in the years ahead. This chart that I've shown on the page now shows the Dividend Aristocrat Index. This is an index of companies that have raised their dividend consistently for 25 years. So again, pretty rare. There are very few of these companies around, but that index has significantly outperformed the S&P 500, the regular S&P 500, since the late 1980s. And beyond the US, the international evidence for this is really strong as well. There was a study in 2009 in the UK that looked at companies with sort of long, uninterrupted histories of dividend growth. And the researchers there found that UK firms with 10 years of consistent and consecutive dividend increases overwhelmingly outperformed the broader market. And they did that with lower share price volatility and shallower drawdowns during downturns. Now, those of you who aren't too busy eating their lunch and are looking at this chart intently will probably observe that during the excesses of the dot-com bubble, this pattern reversed. You can see that in the sort of bottom left-hand side where the green and the yellow reverse course. But actually, in the years that followed that, what we saw was that those dividend pairs actually offered more downside protection than the rest of the market. And there are various studies that go into this as well. So there was another one in the US that showed the outperformance during downturns of the Dividend Aristocrat Index. There's loads of evidence out there that shows that in periods like 2001, like 2008, when I started my career at Baillie Gifford, focusing on this dividend growth as a signal of steady compounder potential is something that really gives you that downside protection. And I think, as we're entering a period that may or may not be similar to some of those past market crises, then I think the resilience of steady compounders in your portfolio could be a very desirable trait in the coming years. One thing in the sort of steady compounder space that's really important is valuation discipline. I think there's definitely a risk that when you're looking at companies that are well covered and where the valuation is sort of easier to conduct on a quantitative basis, then there is a risk in overpaying for that reliability element. And I think that's especially the case because here more than in our high growth investing areas at Baillie Gifford, we're competing with really the armies of the sort of DCF wielding quant focused investors on New York's Wall Street or perhaps closer to some of our audience today in London's Square Mile. But I think over those we retain a pretty clear advantage. Again, coming back to that point about our long time horizon, we know there is only a very small number of firms that can truly beat the fade. And what I mean by that is they can grow like an Atlas Copco for 40 years at that steady rate, long past the point at which most in the markets that are, valuing the company with their DCF and their spreadsheet will assign that terminal value. And I think, we can see that in this analysis that I've put on the page here entitled Mispriced Compounding. What this shows is market adjusted price to earnings ratios for our best performers over the last decade. And if I look at, for example, TSMC is a holding in the portfolio, you can see that back in 2015, the shares were trading just under 12 times earnings. But we could have actually paid up to 43 times earnings and still made a market beating rate of return in that stock. And this is a consistent mispricing that we see amongst these companies that really do beat that fade. Microsoft, you can see at the top of the list there, is a really pronounced example of it. So we're convinced that if that mispricing exists, and if we get our analysis right, then we can avoid those companies that do become average over time, and we'll be able to exploit that and deliver really good returns for our clients. Now, I've spoken a lot about our sort of exclusive focus on steady compounders in this portfolio. And I just want to mention that, while a portfolio of steady compounders does give you that portfolio resilience, you do still need to have lots of diversification at the portfolio level. And I think I want to dispel a misconception that perhaps focusing just on that one type of growth means that you have a portfolio that's not well diversified. What we've shown here is just different flavors of compounding. So we talk about 4 categories. So there's the everyday royalties, the share gainers, market expanders, and adjacency builders. We think these are different ways of compounding value over the long run. So the everyday royalties, just to explain that a little bit, these are companies that are very established, dominant positions in their markets. They're growing at sort of GDP type rates. And their ability to deliver that steady volume growth is often complemented by a bit of pricing power, along with maybe some innovation. And I think companies in the portfolio like Coloplast are really good examples of that. So it's got a really diversified portfolio of treatments serving clients, patients is the word I'm looking for, with chronic care needs. So this is colostomy bags, catheters, things like that. And what Coloplast do is they're constantly upgrading the standard of care, which is bringing in more revenue per sale. And obviously, these are things that people don't want to swap out. And whenever you get a comfortable fit with something like this, you tend to persist with it for a very long time indeed, as well as all the barriers around sort of regulatory approval and stuff like that. So the everyday royalties is a key category for us. The share gainers are typically companies that are growing by, as the name suggests, capturing a bit of market share, typically through superior products, superior services, or a bit of cost efficiency. Car Group in Australia is one that I think is quite interesting. So probably it's sort of business to business, so probably not a familiar name to many, but this is a really global provider of platforms for transacting vehicles, everything from cars to motorhomes. They've got a really good track record of just continuing to innovate on that platform so that it's more and more integral to those dealerships and more personalized to the buyer, which results in better conversion rates and gaining market share from other methods of transaction. Then you've got the market expanders, so businesses that are innovating to create really new use cases for existing products. And I think Novo Nordisk is a lovely example of this. So it's really building on decades of experience in diabetes treatments at the moment, to sort of leverage its understanding of the human metabolism, again, coming back to that theme of today, and to enter the obesity market with its famous Wegovy drugs. And very much, as my colleague likes to say, by trimming waistlines, Novo Nordisk is expanding its market, and that really typifies that category. And then finally, you've got the adjacency builders. So these are the kind of companies that are leveraging competitive advantages in core markets to expand into adjacent industries. So slightly different from the market expanders. I think Atlas Copco I've talked about. Medea would be another example in that category. So it's a Chinese company, really well known for manufacturing competence. It's been a leader over the last decade in white label domestic appliances. They're now expanding into new adjacencies such as elevators, and we expect them to continue to find opportunities to do that based on that manufacturing prowess. So we've not shown the full portfolio here, but I think what I want to get across is that you need to have a diversification in your portfolio. More broadly, we've got 58 names in the portfolio at the current time. That represents, I think, 19 countries and 25, 26 different industries at this point. And the portfolio is pretty flat, meaning that all holdings, really can make a difference to performance outcomes. I think just to tie it all together, I'm sort of mindful of time here. Our advantage of time horizon really does allow us to appreciate the companies that, going back to that original corporate life cycle, they can extend those periods either side of their midlife crisis, where the drivers of growth are really the sort of scalability, the sustainability of their competitive edge. And as I mentioned earlier, Damodaran talks about companies that might age in dog years. So, think about the tech companies of the dot-com bubble, that went from that sort of light bulb moment right through to decline in less than a decade, while others are capable of enduring for sometimes centuries. And so I went back and tried to find, companies that are the oldest in existence today. And one that I found was Kongo Gumi. It's a Japanese company. It's a construction firm that was actually founded in 578 AD. And it was founded to build the country's first Buddhist temple in Osaka. And I read a little bit about this company, and so much of it resonated. The founders there and the family that still have some involvement, believe it or not, they put that extreme longevity down to focusing on a single core competency, the family ownership element, and, as you might expect, an incredible ability to adapt to changing times. And that's something that in our global income growth strategies, we're really trying to seek out those enterprises that can endure for very long periods, those that are able to sort of move beyond Damodaran's sort of early volatile stages and become those steady cash generative companies that really can provide both the growth and the resilience. And as I say, at a time when AI is disrupting established business models, you've got pretty unpredictable policy shifts really buffeting the world's largest economies. I think those traits of durability, those uncommon compounders, I think are going to be a pretty compelling proposition. So I'll just finish by saying a little bit about the funds that we have on offer. So if I've managed to convince you that middle age isn't such a bad thing, then maybe you might be interested in our global income growth, our responsible global equity income strategy, which we're focusing on today, or indeed our Saints Investment Trust, all of which are available here in the UK. And they're aimed pretty squarely at investors that want to participate whenever markets rise and then have that protection whenever they fall, as well as having that valuable and reliable growing stream of income over the long run. And I think, for clients that have a gap in their asset allocation for a portfolio that is comprised solely of those steady compounders. So thank you for listening today. Thanks for giving up your lunch. For anyone that's planning fish and chips for tea, remember that you have to scrape half of the chips into the bin. And I do apologize for ruining anyone's dinner or indeed lunch.
Thank you so much for that, Alasdair. Thanks very much for taking us through that. We've got some questions here from our audience, and I would encourage you as well, if you have any other questions to ask following the presentation, please do put that in the box on the right side of the screen, and we'll ask those. But yeah, we've got a few other areas of questions we wanted to cover, so I'll bring those in as well. So yeah, maybe we start. So given your preference for these steady compounders, is there a risk you'll miss rapid growth opportunities, such as the one really talked about at the moment, currently presented by AI?
Yeah, I think it's unlikely that we'll miss them, but it's probably quite likely that we'll have some caution on them. So I think what we're really mindful of at the moment is just really this risk of overbuild, as the big tech firms really commit pretty mind-boggling amounts of capital to the data center infrastructure that we're reading a lot about in the press at the moment. And I think the thing that strikes us is that there's pretty limited evidence so far of return on investment for a lot of these. Colleague who sits next to me talks about people investing for FOMO rather than ROI, which I think is quite a helpful sort of shorthand for what might be happening at the moment. So to put that in context, the 5 largest AI hyperscalers are expected to spend more than $400 billion between them in 2025 alone. Now, big numbers there, but that's larger than the annual GDP of Ireland. It is a really astonishing sum. And I think that does have some echoes of really the land grab that we have seen at the beginning of previous technology rollouts, such as the dot-com bubble. There's been mentions in the press recently of vendor finance. And I think for some of my colleagues who've been around longer than I have, that term is a pretty emotional one for them and reminds them of some pretty harrowing times. And I think firms like NVIDIA are capturing quite a lot of the opportunity and a lot of the revenues at the moment. But I think we do have some questions about how sustainable that is. So for us, it's about going slightly further down the AI value chain. So trying to find companies that are exposed to that same trend, but with a bit more diversification, a bit more durability, I suppose, to continue the theme of today. So TSMC, I've mentioned, is a holding. All roads lead to TSMC. So NVIDIA, AMD, Broadcom, all of these firms have to go to TSMC to manufacture at the most advanced nodes. And that high performance compute segment for them is only about a third of revenues today. The others are sort of smartphone, automotive, Internet of Things type applications. So you've got your TSMCs, and then I think if you go a layer down, the likes of Microsoft, which is the largest position in the fund at the moment, it has three core businesses, all of which are really clearly linked to artificial intelligence and that sort of productivity trend, and trying to bring the ROI through, the return on investment through. And there's a nice little bonus with Microsoft, which is that within the cloud computing division, adding these AI features is actually driving still more and more people onto cloud computing. Because what we've seen so far is that most of the enterprises that have moved onto the cloud have been sort of digital natives. So think of like a Netflix, companies like that. But it's more firms that have been analog businesses, I suppose, that are still to move. And I think embedding some of these features will encourage them to do that. And then I think probably where we're perhaps most different from the market is that we are beginning to see some applications for some of these features. And one of our best performers in the past quarter was a company called Cognex. So Cognex is a specialist in machine vision, really interesting company, very, very unusual corporate culture. I encourage anyone out there, if you want to read an annual report, go to Cognex, because they're actually very entertaining, believe it or not. But this is a company that makes barcode readers, quality control cameras. So if you imagine on a manufacturing line, it'll check the fill levels and beverages, things like that. And it's really struggled to apply that technology to some areas which human eyes are really still required to reliably detect defects. So if you think about packaging or things like this, the shapes and the textures of materials are all quite different. Whereas when you embed AI into this process, all of a sudden they can interpret those nuances and do a pretty good job of it. So overall, we've got about 15% of the portfolio by weight that's, we would say, pretty directly exposed to the AI revolution. But I would say that's further down the value chain towards the software and application layers and away from that risk of overbuild, which I think for this kind of strategy is the sort of prudent positioning.
Yeah. And what about AI integration for the other companies in the portfolio? Because it's something every company's looking at now. And you were talking about competitive advantage going forward as well. It's quite important now, isn't it? Thinking about their strategies. How are you seeing that across some of the other sectors out there?
Yeah, well, you're absolutely right that everyone is talking about it, and we had a look at company earnings calls and the kind of terms that were coming up, and sure enough, everyone is mentioning AI and how they're integrating it. So the task for us as investors is really discerning where that's plausible and where it's not. Where you have a Cognex type example that you could see how AI could be leveraged to really improve the business, or the company's just using the recent sort of hot word. But it really is affecting every company in our portfolio. I was just looking yesterday at L'Oreal, which is holding, and how they're using it to help people match their skin tone to the right cosmetics, things like this. So, right through to the kind of companies that you might not expect, AI is definitely being deployed. And by the way, as investors, we're using it pretty significantly as well. So, one really easy win for us is we're able to now load in our thesis for an individual company, compare that versus the most recent earnings transcript, and ask the artificial intelligence to sort of identify inconsistencies. Where are we on or off track? And that's a really helpful piece of analysis for us, because of course it does it in an unbiased way, right? It doesn't have the bias of an investor who has held that stock for perhaps 10, 15 years. And also, it allows us to really broaden our range of inputs. So if there's a company that has a small business in India, for example, I might not normally spend the time looking at that particular element, but very quickly now I can get a deep research report on that particular segment and have a read through and understand whether or not I want to do more work on it. So I think it's helpful not just for the companies we're investing in, but for us as investors too.
Yeah, no, it's really interesting to hear how you're using that there. Let's just follow up a bit around your talking about your position on some of the AI names, and obviously we've seen a very strong run for technology more recently again. But so let's talk a bit about relative performance on the fund, which has been poorer in the near term. And I suppose what's the main reasons behind that? You mentioned obviously about if AI is having a great run, some of those big tech stocks, that's going to be harder for you in that environment. But yeah, maybe talk a little bit about the performance and what's been happening.
Yeah, no, I think that's you're absolutely right. It's been a very tough 21 months for us now, like almost exactly at the beginning of 2024, when we started to see pretty extreme levels of index concentration. I think 25% of the MSCI ACWI, which is our comparative index here, is invested now in 10 names, and 9 of those are US technology businesses. So, there is, if we were to invest in that kind of asset allocation for our clients, we wouldn't be doing a good job for them. So our portfolio is more diversified, and as a result of that, we have definitely lagged the index in the recent times. Interestingly, the conversations I have with clients is that they're entirely understanding of that. They don't want us to be, we're not in their portfolio to deliver that sort of Mag 7 type of growth. We're there to give them that protection at more difficult times. And so they accept that we're not going to keep pace with very strong index returns. But you're absolutely right. As a growth manager, being underweight the so-called Magnificent Seven, I'm very cautious of sort of acronym investing, as one of my colleagues calls it. Because those are 7 very different companies. We do own 2 of them. But being underweight that group has been unhelpful for returns. The interesting thing for me, and I think something that sort of goes almost under the radar of a lot of market commentary, is that growth has been doing very well in the US, driven by those names, but elsewhere in the world, value has been outperforming quietly for quite some time now. And so, we're underweight US to the tune of about 20%, depending on which portfolio you look at, and the corresponding overweight is in Europe. Now, Europe value has been doing very well, driven by a couple of the sectors that we wouldn't own in this portfolio. So banks would be one. I've talked about, why we would have some caution around cyclical businesses, why those wouldn't be suitable for this portfolio. And then defense names would be another. And I think I saw a question flash up there about suitability for defense names. Very capital intensive.
That's right. Yeah, we had a question around.
Sorry, go ahead.
Yeah, that's right. We had a question around defense stocks. Has the Ukraine war increased the importance of defense stocks, even for supporters of responsible investing? And there has been this debate, hasn't there, around defense stocks in ESG portfolios?
Absolutely, yes. And I had a conversation with a client that historically has been very committed to sustainability and responsible investing. Recently, who put it very bluntly to me, he said, we're thinking about compromising on our morals to improve our returns. That's where we are now in the sort of ESG hype cycle, if you like. I think for us, we have the ability to look out over that 10-year time horizon. And I think companies in the defense space are really susceptible to a lot of forces out with their control. We're seeing that in the news every day at the moment. And those are not the kind of qualities that provide you with that steady sort of durable return profile that we look for. So I think by avoiding those kind of areas, I think what we're doing is safeguarding the resilience of our portfolio, even if that has been pretty uncomfortable in the short term. I should say, we have had some stock specific setbacks as well as the stylistic headwinds. We've owned things like, I mentioned Novo Nordisk. It's been under pretty intense pressure in recent times. So recent results, it reduced its sort of guidance, I think, from 17% for the full year 2025 through to about 11%. And the share price fell pretty considerably as a result of that. Now, that's because there's been really strong competition from Eli Lilly, as well as the compounded sort of copycat versions of the GLP-1 drugs that until recently were, driving that share price higher and higher. So there's things like that have weighed on performance as well, but we think are temporary effects. That's a company that we still have a lot of faith in. It's going through a reset at the moment, but it has huge amounts of manufacturing capacity that I think will come to be very important in in the future. We think there's plenty of room for them and Eli Lilly to do very well out of obesity drugs. And by the way, it's trading on, I think when I last looked, 12, 13 times earnings. So, very much the sort of odds are skewed in the favor of good returns from here with companies like that. So, we've had a few stylistic headwinds, but we've also had a few stock-specific setbacks. And when you have those all at the same time, it can feel pretty punishing. But I think the important thing for us is to remember that, as investors, sometimes you seem like a genius, sometimes you seem like an idiot, and often, most of the time, neither of those things is true. And so you just need to focus on the things that you can control. And for us, that's about looking at company operating performance, making sure that it's still making the progress we expect, and judging it on that basis rather than how the share price is ebbed or flowed.
And in terms of those stock specific issues, did you have sort of learnings from those? Were there things you think you could adjust your process, or I presume there were different sort of issues that came up? But
so one thing we've been doing recently is looking at, in conjunction with our risk team, a bit of inertia analysis. So inertia analysis is where you look at your portfolio as it is today and how it's performed versus one that you didn't trade. And so, what value have you added through new buys, complete sales, additions or reductions? And actually for Novo Nordisk, we did very well. So the analysis showed that we trimmed it right at the top, we added at the bottom. We bought it, I think back in 2016. So well ahead of that GLP-1 run up. So the trading there was really good. But for some other names, we've been, as a downside of being very long term, we've held on for too long, or indeed we've added on weakness whenever the share price is going to fall further. Companies like Eden Red in the portfolio, which actually was over the past couple of days has showed a bit more promise. So we're constantly looking at our investment process and seeing how we can improve as investors, because you're absolutely right. There may be a disconnect between operational performance and share price performance. And we may focus on the former. But is there something that we can learn from the share prices and how at a portfolio construction level we make sure that we don't have undue concentration or correlation that might affect the sort of volatility profile that our clients expect?
Yeah, that was interesting to hear you talk about that. We've got a couple of questions here. So we'll maybe just whiz through the next few because I'm just conscious of time.
Okay.
Maybe you could just talk to us about the yield on this fund.
Yeah, sure. So this is a pretty common question for us. 2.5% yield is pretty low for an income focused fund. The typical question is, why wouldn't I just put my money in a bank and earn that sort of 4% level of interest? I think the thing I would stress is that here we're focused on long-term income, not short-term yield. And what I mean by that is, while you may get that 4% interest rate at a bank, the capital doesn't grow. And so if you can grow the capital and get a 2.5%-ish yield on that over time, your actual income level in the future is much greater. Now, we quite often, I don't have it in my pack today, but we quite often show a chart of the dividend paid by Microsoft versus German utility RWE over the past decade.
Yes.
And what it shows, some of the audience might have seen it before, but what it shows is that a decade ago, if you had been a sort of an income-focused manager, it would have been an easy choice. You would have invested in RWE, that German utility, because it was paying a 7% yield. And that was 3 times the level of Microsoft back then. However, RWE's had to pivot its business away from coal and nuclear towards renewables. That required pretty heavy investment. It cut its dividend. It suspended it afterwards in 2016 and 2017. Meanwhile, Microsoft continued to sort of grow its earnings, and dividends had grown steadily as a result of that. And actually what you've seen is pretty significant ramp up in the capital value of Microsoft over that period. It's a 7-8 bagger, I think. And therefore the total income, the yield on that initial investment is around about 10%. So we're very much focused on the long-term income, not the short-term yield. And that, by the way, gives you that reliability and resilience in the income stream that we know investors in this type of fund really value.
Just conscious of time, so we'll whiz through a few more questions here. Can you give us some examples of those more sort of middle-aged companies in the UK?
Oh, yes. UK names. Look down my list. We don't have many in the portfolio at the moment. I immediately cast my eye on a problematic one, which is Fever Tree. So maybe, and it's indeed not invested in our responsible portfolio, which is the focus today. What other names have we got in the portfolio? Admiral is a good example. So, and does it fall into the middle-aged category? I think it's a relatively new insurer, but I think it really exhibits a lot of the traits that we see from older companies. So it's had a pretty tough time because the regulatory environment for insurers in the UK has been quite difficult for a number of years now. There's been a lot of uncertainty there. And it had been trying to grow into the US, perhaps sort of not acting its age, making one of those mistakes that I described at the start. But actually, we've recently seen it cast off that US business, and the share price has responded really well to that. I can see on my screen here that it's up 27% year to date. So yes, there are examples of it in the UK, and I think we'd love to invest more in the UK than we do. But this is a global portfolio. We have a very broad opportunity set. There's something like 9,000 companies worldwide that we could invest in. And so it's a really high bar to get into the portfolio, and our UK exposure's fairly low as a result of that.
We've got a question here. I think you've touched on this in terms of talking about what you're looking for with the fund. But while there is disconnect between exuberant stock markets and the struggling economy, how do you manage your clients' funds when your mandate does not allow you to hold cash? Or not
so I mean,
very high cash rating.
Yes, I think we're seeing interest in this strategy at the moment because people do have concerns about frothy markets and what that might mean for some equity investing approaches. Now, I think the thing I would say is, and the question's absolutely bang on, we are an equity fund. And if markets do really poorly, the fund will be down in absolute terms as well. But going back to that slide that I showed with the 12 market crises and the 10 periods that we outperformed, I think what we aim to do is to outperform that down market. It's very difficult to time your exit and your entry point in and out of equities, as I'm sure everyone on the call today, the webinar today knows. And so what you want is something really at the heart of your asset allocation, the heart of your portfolio, as an allocation to growth equities that would really allow you to benefit whenever markets rise and participate in some of that growth while also providing that downside protection. Now, our performance objective on this fund is sort of 1 to 2% per annum over the long run. And I often say to clients that we're not going to earn that in a period of really exuberant markets. We're going to earn that whenever markets are falling. So we're going to outperform on the downside. The downside capture is going to be better. And so, I would say you want to have something that sleep well at night, right at the heart of your allocation. Obviously, if you're great at timing, you can move in and out of cash, then by all means do that. But I think we all know that that's very difficult to achieve.
Yes, yeah, of course. So a couple more questions here. Again, I think you mentioned this. We're talking about the portfolio construction, but how is concentration risk managed in the fund? Maybe you can just say that very, very briefly.
Yeah, very briefly, we have a set of sensible diversification guidelines. So the main one to mention would be we don't go beyond a 5% position in any given stock. And so you'll know that perhaps you'll know that other Baillie Gifford strategies can take much punchier positions. Here we have risk guidelines that are lined up with the type of client and the type of risk profile that our clients have.
Great. And just finally, can we talk a little bit about, we've got responsible in the name, and there's obviously a lot of discussion around how funds are being categorized. How would you describe that element to clients? And have you gone for an SDR? Have you tried to go for an SDR label? How do you sit within the framework that's come in the UK?
Yeah, SDR was a long period of toil for me, going through what was a pretty arduous process with the FCA earlier in the year. This fund is non-labeled, so it does, as the name suggests, promote some ESG characteristics. We do have a dedicated ESG analyst on the team who has a right of veto over the portfolio. We also have some exclusions across the 6 main sin sectors. But I would probably characterize this as very much a do no harm type approach. I would say it's, if anyone's familiar with the spectrum of capital that some people look at in terms of different flavors of ESG investing, it's a responsible strategy rather than a sustainable or an impact strategy. And we do, by the way, have approaches that follow those sustainable and impact flavors of ESG investing at Baillie Gifford as well. This sits in a distinct category.
So I suppose it could look different in terms of your other funds within the global equity income sector. And there aren't a huge number of responsible funds within that, but
yes, that's right. So
the exclusions and
I think the current time there's 6 names different between our global income growth strategy and our responsible income growth strategy. Those are mainly the Diageos and Pernod Ricards of this world, which are excluded by the screens that I've mentioned. But then also on a sort of principles-based screen, the right of veto applied by our ESG analyst screens out things like Fever Tree, which I very briefly mentioned earlier. It's not per se an alcohol name, but it's clearly consumed along with alcohol and therefore not suitable for a responsible approach.
Yeah. And just quickly then, talking about that overlap with another fund there, another question we usually get on these is about overlap between the Baillie Gifford funds. And we were talking before this about that. What would be the overlap in terms of holdings with some of the other names that are held more widely within other funds people might know at Baillie Gifford?
Yeah, we're pretty different actually. So depending on which strategy you look at, 15 to max 20% overlap in terms of common money. So the number of names held. So this is its own team. We're distinct from our other strategies, and for all the reasons I've laid out today, we need to be quite different to the other strategies that Baillie Gifford has become famous for. And so I think that's very much a strength of the process here.
Great. Well, thank you so much for taking us through that and answering those questions. I think we covered quite a few there, but if you do have any other questions, then do please contact the Baillie Gifford team, and I'm sure they'll try and help you with those. So before we wrap up, let's just take a quick look at those learning objectives again. So it's developing an appreciation of the merits of quality growth investing, understand how consistent dividend growth can signal compounder potential, and learn how durability may become a prize trait in future market environments. So thanks again to Alasdair for joining us and for your questions. Just to remind you, your CPD will be delivered tomorrow. And just before we go, I'm just going to give you a little quick walkthrough of some of our events that we've got coming up for Professional Advisor. So on the 5th of November, we've got another Professional Advisor working lunch, again with Baillie Gifford, but this time it's Stephen May, Investment Manager, and he's going to be talking about unlocking opportunities beyond the US. Why now for the Baillie Gifford Managed Fund? Then later in November, we have our Retirement Planning Roadshow. That's going to visit Harrogate, Warrington, Coventry, Bristol and London on the 18th, 19th, 20th, 26th and 27th of November. We've got presentations there from Just, L&G, Premier Miton, Quilter Cheviot and Standard Life, and a keynote presentation from Aberdeen Advisors Pensions Guru Andy Zanelli. It'd obviously be really interesting timing on this and be really good to hear Andy's views as we prepare for the upcoming budget and the impact for your clients. Then on the 4th of December, we've got another digital working lunch. This time we're going to be joined by Baillie Gifford's Rosie Rankin. She's going to be talking about their positive change strategy. And finally, we're closing the year with our last working lunch of 2025, which will be the 11th of December, where Schroders is going to present the results of their ever popular annual advisor survey. So there's a lot there, total of 9 hours CPD over the next couple of months. If you wish to find out more information or sign up, you can do so by visiting professionaladvisor.com/events. So that's all from me today for today's session. Thanks again to Alasdair. Thank you very much for your questions. Thank you for joining us today over lunch. I hope you found the session helpful, and we hope to see you at another Professional Advisor event very soon.